would you ask if you had 3 financial pros in the room with you? On 5Q IQ Financial Power-Ups with Trajan Wealth, we take 5 real questions every week and we unpack them in plain English, from tackling debt and budgeting to investing, taxes, and even retirement. If you're tired of one-size-fits-all sound bites and want real conversations that help you think more clearly about your money, then you're in the right place. So let's dive into today's 5 questions. And I'm sitting here with Corbett LeDuc and Marti Bryant. And combined, we have darn near 100 years of experience.
Mm-hmm.
Scary. So let's get into question number 1. Won't the impact of tariffs really hit next year and not this year? So are tariffs terrifying?
Oh, good Lord.
No. I mean,
It's already starting to hit right now.
well, yeah.
A little bit.
Because it's more about the fear of it. And that's what we saw, the pullback from January.
So they are terrifying.
Terrifying.
No, terrifying. No, not quite. Because knowing what negotiations are going to happen with each countries, has been going on for quite a while. And that was the slide we had from, end of January to middle of April. Market bounced back from that. But so many companies have already raised prices for that, offsetting that, especially if they're importing a lot from China and different places outside of the United States, obviously. A lot of companies have on-sourced different things on there, like BMW, perfect example. They build all their SUVs in Alabama.
But the parts are coming from outside of the U.S., so the parts are going to potentially have tariffs associated with them.
Very true.
So you just have to, there are going to be some companies affected and some companies that aren't.
Right. I think the tariffs part that could have an impact further down the road are on earnings. Because, there's only so much pricing power that you can raise prices on something to offset that. Mm-hmm. Because sooner or later, consumers are going to be like, you know what, that's enough. I'm going to look at other alternatives that are out there. For if you normally shopped at, let's say, Nordstrom, and now you are shopping at Kohl's.
The other thing to take into consideration, though, is with tariffs, let's the reality of it is, if there are companies in the U.S. that are being affected by it, then we might see job losses here in the U.S. Right. We have reduced profitability of some of these companies. They might not, let's say that they
which
don't
can bleed into next year.
Right. Let's say they don't pass all of the tariff along to the consumer. Now they're going to have potential reduced profitability. And again, which is going to correlate to less payrolls, less manufacturing here potentially if they're importing some of those assets to create their end goods.
Right.
And which I think, we're feeling some of it. But again, it's going to be determined if you're just concerned about your portfolio, what are you invested in? Maybe make an adjustment within that portfolio. We have the 2 that Matt Kofina, he's running our moat strategies. He's not really that concerned about tariffs within those portfolios because very few of those companies are subject to items that are going to have tariffs on them. And I don't know the number on this, and I'm going to look it up. But as I recall, I believe that Trump was reducing or eliminating tariffs on pharmaceuticals coming in. Do you guys remember hearing about that?
I heard about it. But
yeah, I'm going to look that up real quick because that's obviously one that's very impactful.
But what about the surplus that the tariffs are giving the country? Do you think that's going to offset what's being lost on the other side?
I mean, maybe, but depending upon how that surplus gets distributed. If it's really just going to pay down the national debt, which I think would probably be the best option for that, just because it's so big, is going to impact the future more. But the tariffs that are having, the biggest impact, are on parts being manufactured outside and coming in here for the end good to be done here. I can't remember how much has been raised already, but I know it's been a fair amount. And so far, you don't really hear much about new trade deals like with Vietnam or whatever it might be to make it equally fair for all countries that we trade with.
Tariffs will definitely impact companies next year.
Oh, yeah, for earnings.
But they already have this year, too.
Right.
I remember when tariffs were announced, a company that I've used numerous times is Restoration Hardware. They import darn near everything.
Oh, I'm sure.
And when tariffs were announced in that single day, they were down 40%.
Yeah.
Oof. That's huge.
Oh, I remember
that's
that.
huge.
Yeah.
Yeah.
And that's why largely Trajan stays away from these companies that are really reliant on foreign manufacturers.
Right.
Not just because of the tariffs, but because of all of the other variables that come
Right.
along with it.
Right.
The dollar and all those different things.
Right, exactly. So again, if somebody is in just all ETFs or all mutual funds, you're getting a basket of a whole lot of stuff.
Right.
And so maybe if you are really that concerned, do some homework on what you're buying, right? Or talk to your fiduciary, and hopefully all of you at this point in time are working with a fiduciary and not one
If not,
that's,
I know a good one.
I know I am a very good fiduciary.
I wasn't
Corbett's
talking about
working
you.
on it. He's
Yeah.
working on it. Just like his IQ, I think he got a little smarter on the program last week, which is what we're.
This has helped.
It's helping. It is helping.
Talk much good, yes.
Yes, you do.
Yes.
You do. But really, it is going to. What relationship do you have? What kind of research are you doing on your own if you don't want somebody to manage for you? Do your due diligence.
Right. You know, you mentioned mutual funds. I think mutual funds is kind of a side topic to this, but with mutual funds, it's a grouping of companies, 500,000 companies.
I looked at one. I had a gal come in. She had a bond ETF, 3,812 bonds in. I'm sorry, mutual fund.
Way
in
too much.
And she's like, I'm not making any money. Right.
Yeah.
Yeah.
You're so diversified, you have no chance of outperformance at all.
But the scary thing with the mutual fund is they have to be that diversified.
Right.
They have certain rules that they have to adhere to. So the money managers may know better than to buy some of these that are going to be impacted by tariffs, but they don't necessarily have a choice because they have to meet certain diversification requirements. And while diversification on the surface sounds good, you can have too much diversification. And they're much more expensive than an ETF. An ETF gives you similar diversification, if not more, but it's a set static portfolio.
Yeah.
And the tax efficiencies with an ETF compared to mutual funds, are like night and day.
Right.
You know?
Well, my favorite is when somebody comes in and they say they're working with a fiduciary, and we look at their statement, like they come in like from Edward Jones or Fidelity, Vanguard, Merrill, guys at the bank, and I look at their statement and I see that there is a fee being charged, but they're in an all mutual fund portfolio. How lazy can you be? So you've got a guy or gal who's not even managing your money, throwing you into, I'm using my fiduciary license because they're all duly registered.
Right.
Charging a fee, and they're doing not a darn thing for you.
And the mutual fund is charging you just as much
Bingo.
behind it that you don't even see because it's not reflected on your statement.
More likely, BlackRock mutual funds. Oh, wow, shocking. Merrill Lynch and BlackRock have a partnership.
And it doesn't have to be disclosed out loud. Go read your prospectus.
Right.
Yeah.
So question number 2 is, how are rising interest rates impacting the valuation of growth companies?
2022 was huge. You saw a lot of debt-laden and debt-needing companies just getting absolutely crushed.
Yeah.
Knowing that the way for them to grow is to borrow. That's okay in the beginning, maybe, and while we're in a reasonable interest rate environment. But when you go from a carrying cost of 3% to 6%, basically that's a double. Now your interest expense has doubled. How are you going to be able to offset that with, you're not going to be able to really raise prices because then your competitors may not be carrying as much debt. So the ability to know that, hey, having what you need and not borrowing any more than that. So I think for a lot of, growth companies, they just, have gotten crushed on that part. Now interest rates have gotten a little bit better, at least on the near term. The long-term parts of the yield curve have really not fluctuated a whole lot, which is not helping the mortgage market. So the real estate side, a little different story. But for a lot of companies that are needing to borrow, it has a big impact on how much they can really grow.
It doesn't necessarily mean they're a bad company.
Right.
It just means they can't get the capital
Right.
as easily. Yeah, so in a rising interest rate environment, the strongly growth-oriented companies that can't finance themselves, you consider Apple still a growth company, Microsoft still a growth company, but they have the ability and the capital to finance themselves. They can
And
take
they
it out
don't
of
need
their
to
own
carry.
bank.
For both of them, I don't think either one of them really have any debt.
Right.
Because they don't need to, because they've got so much cash generating that they don't really need that. Compared to your point of small and mid cap company, they're not that fortunate. They're in a different cycle of growth for that, where Microsoft and Apple were back then, where they had to borrow, but they're very fortunate because interest rates were much easier and better back then.
And again, we're going to use the word that we keep the consistency that we have is diversification. You have to diversify your assets. So maybe look at a value stock. right? So maybe this is the time that we go to, instead of just focusing your portfolio strictly on these AI high growth companies, continue to invest in those, but maybe diversify out into a value stock, which traditionally, this is an easy way to explain it. They're sometimes like the backbone of the country, strong foundations, deep roots.
Union Pacific.
Right, Johnson & Johnson, Verizon. So these companies, they're not in that growth phase. They're not trying that exponential growth.
Well established.
Yep. And they're not reinvesting all their money back into themselves. So they have free cash flow, low debt.
Right.
They do merger M&A kind of stuff to grow. So kind of like what's happening with Warner Brothers, Discovery deal. Netflix is picking them up.
Which is interesting. They floated a bunch of debt to do that.
Yes, they did. But we won't get into that because we'll go down another rabbit hole. But now they're going to offer dividends. So they're going to pay you to own them. So there's two ways to grow the account, right? Organic growth and then just grow through the dividends. Right. So get that bit of diversification.
So really with high interest rates, with interest rates as high as they are, just like a family buying a house, you can't afford as much of a house as you could when interest rates are low. Businesses suffer the same issue and the same problem, especially growth-oriented companies. So let's move on to our third question. Is Trajan using stop loss in case of a crash? And how does Trajan protect the downside?
Great question. So no, we do not use stop losses. The ability to be well diversified, because if you use that stop loss and then you get stopped out, you're already out one, but two, you have to be the second time when you get back in. Mm-hmm. So
again,
for us,
it's like timing the market.
It is. And, the ability to say, hey, because I have clients ask me all the time, hey, what are you guys doing to protect the downside?
Let's even back up. Why don't you explain what a stop loss is?
Sure.
I imagine a lot of people don't even know what that
means.
So
a stop loss is that if you have the price of, let's just say Microsoft at $100 a share. Mm-hmm. And if Microsoft, let's say, breaks $90 a share and you have a stop loss, it will trigger that order to sell Microsoft if it hits 90 or less. Mm-hmm. So if you have a huge gap down, and you're even below 90, you could be at 85, and now you're at 85, and you're like, well, I didn't think it'd be that much lower, but the ability to be properly diversified so that we don't have to worry about that, because once you do get stopped out, let's say it was an intraday bad news, something that was not really truly related to Microsoft, market overreacts, and then it bounces back the next couple of days. Well, if you didn't get back in immediately, then you've sold at the low, you're not participating on the rebound for it. So knowing that there are other ways to protect your downside, diversification, something guaranteed like an annuity, but knowing that there are other options compared to trying to time the market.
Or in case of some of our accredited investors, we can completely have uncorrelated assets. We can get into private equity, private credit. And again, that's why we have our tactical money managers. There literally are a team of people every single day. Their entire job is to reevaluate the stocks that we own and the portfolios that we have. If there's a fundamental change to a company,
right,
we're not married to it. We either sell out of the whole position if necessary, or we can further diversify out of that position. Right. I know United Healthcare was in a couple of our portfolios, one of our money managers. And so not all money managers manage money the same way.
Right.
They read things differently. One of our fundamentalist managers, he sold out of United Healthcare 3 months before the crap hit the fan. And then the other one, he's like, no, there's still value here. And he held on to it, and it's making its way back. So it's just two trained schools of thought and different ways of managing money. Right. But there are human beings evaluating this every single day.
Right. It's not just AI.
It is not. Thank God it's not AI. I'm not saying at some point it might not take over, but you have to have a human being. You need eyes.
Well, you need to have checks and balances on what you are interpreting. So I think an even more relevant example of that is Oracle. And
absolutely.
The partnership that they had with OpenAI. Huge fanfare in the beginning, and then it just started to say, oh, this is not what we really thought. And if you look at where Oracle has gone in the last 90 days, it's down 37%.
Yeah, how much debt?
I'm sorry, even more than that now, because they gapped down 12% this morning off of their earnings.
Yeah.
Because of the expectation that, hey, this OpenAI deal may not be as beneficial as the market first interpreted it when it was announced.
And when we sold out, we sold out a couple of months ago entirely of the position. We were up 81%, and Kofina even sent us a note saying, hey guys, there's probably room for it to run a little bit more, but I'm not willing. I'm willing to take that chance, and it's time to get out.
And he was absolutely right.
100% right. Yeah.
Yep.
So
ultimately, how do we protect the downside? Diversification, investing into portfolios that we know the long-term risk with, long-term reward with.
Right.
We don't believe in stop losses because essentially it's like timing the market. Timing the market never works. In one of our episodes, we spoke about that specifically because we had a question from someone who asked about just going to cash.
Right.
So we poo-pooed that. Stop losses, not good.
Not good.
Great.
Not for us.
Yeah, not for us. If you're day trading something, then hey,
Right,
protection.
right.
But that's not
High
us.
frequency, something like that.
Retail
Right.
investor who gets scared.
Right.
Right.
Let us do our job. You go do your job. Let us do our job.
If you want to play with something, have a stop loss on your account. That's something different than
Right.
hiring a fiduciary long term.
Right. Exactly.
Not lifestyle money.
We talked about being 1% better. And I think you shared with us the other day, I think it was Corbett, we talked about, or Jeff talked about, when you hire a professional, you are 3% better return.
Right, from the Dow
on
bar.
average. Right, from the Dow bar.
Based upon a study.
So, I mean,
Independent study.
an
right.
independent
Not
study.
a study Trajan did.
Independent.
That's right, absolutely.
Trajan.
Dow
Yeah.
bar, I think it was done in 2002, so it's been out there for quite a while.
Yeah. Yep. So,
3% per year. You compound that over 10 years, 20 years, that's huge.
huge returns.
So let's get into question number 4, which is, what are RMDs? When do I have to do it? What accounts are impacted? How are the amounts determined? Are the amounts taxable? And how can I avoid those taxes if they are? Let's
Great
get
question.
into it.
Yep.
Lots of questions.
Yep, required minimum distribution
Correct.
applies to pre-tax IRA accounts, so traditional rollover IRAs,
401ks, 403bs, 457s.
unless you are still working for them. So if you're still
Unless
employed,
you're still employed.
Right.
if you're still employed with the
SEPs.
401ks,
And-
SEPs,
yeah.
same thing. So anything that's got pre-tax money in it, Roth post-tax accounts do not have RMDs because it doesn't benefit the government any. So that's part of the reason why they don't have to do that. But having a balance for it helps to minimize the pain that you might have from an RMD. Because a lot of times in my meetings, I'll show clients, hey, you are 58, you've got $1 million right now. If you don't intend to touch this, and let's say we extrapolate this out 15 years, and let's say you get 8%, that's going to be a huge number that you're going to have to take out that you may not have been expecting for that.
So, prior to the Secure Act 2.0, your required minimum distribution age was 70 and a half.
No, Secure Act 1.
Secure Act 1 was 70 and a half, then it raised it to age 72. Now 2.0 is 73. And
Depending upon your age.
The RMD is a required minimum distribution on qualified accounts. So a qualified account
Well,
is
Roth
any...
is qualified though.
Well, right, but
Pre-tax.
hear me out. So a qualified account being any account that you put money into that you didn't have to pay taxes on at that point.
Right.
And when you take it out, you're going to have to pay taxes on the entire amount. So 401ks, like you mentioned, are probably the primary, IRAs, et cetera. And then what we're moving into is the ages that you're required to start taking money out. Because the thing with RMDs, and the reason they exist in the first place, is because the government wants to tax you before you die.
Right.
That's why they're requiring you to take the money out, because remember, the money that you put in, you haven't paid taxes on yet. So they're requiring you to pay taxes before you die.
Yep.
Right, which is a good point from probably 20 years ago. They called them stretch IRAs. So,
Stretch, yes, I remember
so
that.
John Kerry from Massachusetts, very intelligent man, put all of his grandchildren as beneficiaries on his IRA accounts because back then the RMD amounts were based upon age. If it was a non-spouse, Secure Act 1.0 changed that and said if it's a non-spouse inherited IRA, so if you pass, it goes to your spouse. If I passed and got hit by a cement truck and went to both of my kids, my traditional IRAs would have to be emptied out within 10 years. So the IRS is still debating whether you can delay it for 9 years and take it all out at once, or if you have to take out a certain amount.
But even though they're delaying it, we still have to take those RMDs.
Not if it's non-spouse.
You do. You have to take a portion of the money out. They just didn't say how much. So, and it was also called multi-generational IRA, stretch IRA, multi-generational.
Right.
Which the thought process behind that was you now were taking that RMD based on your age. And so that's why it was
Right.
beneficial to the grandchild.
Because they're so young.
still young and, you know,
Right.
we should be able to have money left over for generations to come. But with the Secure Act 1.0, the IRS doesn't want that money stretching out over lifetimes. They want that tax money, right? So they cut it down to 10 years. So as non-spouse, it has to be, because the reason why we keep saying non-spouse, if you are married and your spouse dies and they have that qualified account, you can inherit that account as if you have always owned it. Right? So now for the non-spouse, they have to inherit it as a beneficiary IRA or an inherited IRA, which then triggers that, hey, you have 10 years to free up all that money because the IRS wants their taxes off
As
of it.
well as a Roth non-spouse inherited IRA.
Correct. Even on a Roth non-spouse, they want you to have that fully depleted because they don't want that tax-free money they want, because a Roth account is after-tax money that was put into an IRA, which is a Roth IRA, and it grows tax deferred, and all the money comes out tax free.
Right.
So they don't want us to have the ability or the benefit of that either.
Right. So
10-year window.
Go government.
It'll be interesting to see if so I'm going to take out $1 on the Roth side. Pre-tax dollars, that makes no sense. What I tell most of my clients is if that happens, take out at least 12 to 13% a year, because you don't want to get into the 10th year and say, oh, hey, I have to take out $500,000. You jump up 2 different tax brackets, and then now you just smoked away so much of the capital that was in that account, all because of not taking little bits of pain along the way.
Right.
But to answer your other question, how it gets evaluated on December 31st of the prior year, based on your age at that time, says if it's $1 million, and at age 73, there's this fun thing called the Uniform Lifetime Table. The factor is 26.4. Divide that number by 26.4. That is your RMD amount that you have to take in the following year at some point during the year. December 30th, January 3rd, doesn't really matter, as long as it's on that tax year.
Yep. So it's based upon the value on December 31st, the prior year.
Prior year. So now let's talk about ages. So if you were born in 1950 or earlier, age 72. If you were born in 51 to 59, that's age 73, and that started in 2023. 60 and beyond is age 75.
Is there something past that, or is that it?
No, that's it so far.
Okay.
That's it right now. And again, so let's kind of tie this back. Why are they doing that? People are living longer, but Social Security is underfunded. Right. So now let's do a little just a real quick synopsis on that, because I'm sure we're going to have Social Security questions along the way. But it's also tied, now people are working longer, they're going to pay into Social Security longer. So now, since our RMD age is at age 75 instead of 65, where it started, right? 65, now we're 10 years beyond that. It's going to probably force us to have to work even longer, because unless you are building your own pension and you're a good steward of your assets, or you are working for a company that actually has a pension, which shocking if there's many, around, you're forced to stay in the workforce longer, thus paying into Social Security longer.
So we've determined that when you take RMDs, they're taxed.
Yep.
So what are they taxed as? Capital gains, ordinary income? Ordinary income. What if I just don't take my RMD? I say, forget it. I don't want to pay. Let's say I'm in the top bracket, 37% currently. I don't want to pay 37%. I'm just going to leave it in there. I'm going to forgo this whole deal.
Well, hang on. Let's be realistic about our taxes. It's a sliding scale. No one pays 37% on 100% of their income.
Right.
So it's your effective tax rate.
Right. But that RMD is going to be incremental income, so it's going to be income all on top.
Right. So if I take an RMD, I'm now at 37% and above, let's say.
Okay.
Prior to that, let's say I was at 35%, but now because of this darn RMD, I'm at 37%. Forget it. I'm leaving it in my account.
Yep.
So sounds great in theory, but the IRS knows that. So if you don't take it, there's a 50% penalty.
25%. That happened to the Secure Act 2.0.
So January 26 goes to
25%.
25%, whereas if this year's 50%. Now, if you say, hey, I was in the hospital, I wasn't sick, I wasn't very smart, typically the IRS gives you a kind of a one-time thing. Hey, yep, we get it, you missed it. The second time, they're probably not going to be quite as gracious on that part. But the part that you can do to minimize that, especially for a lot of our clients that do tithing, once you reach that age, actually 70 and a half, you can do what's called a qualified charitable distribution. You have the ability to say, hey, if my RMD is $30,000, I typically tithe $10,000. Well, if you're not itemizing your deductions, that tithing's great, It's just for your heart. There's no tax benefit
Right,
for it.
right.
Compared to, hey, I'm a tithe 10,000, my RMD's 30, I can take 10,000 directly from my IRA, give it directly to that 501c3 organization, and that $10,000 is not taxed at all.
Right.
So all you get taxed on is the $20,000 for that. So that's what I guide a lot of my clients that are looking to minimize that is one option. So instead of funding their tithing through cash, this is a much more tax efficient way to do that and know that, hey, you're still doing a lot of good things even though you are taking the standard deduction.
Right.
Now, the other part that a lot of people don't think about for those RMDs is this other fun acronym called IRMA. So IRMA means that you are going to get taxed or penalized even higher monthly amounts on your Medicare. So they don't really care if you sold a house or something along those lines. It's 1 year behind, but you get penalized for 2 years, where a standard Part B Medicare payment is $168 a month. If you, let's say, sell a house, $250,000, your IRMA the following year is going to go up to $348 a month. If you have income above $350,000 on that, it goes to $524. So if you're going to have those high of amount of RMDs, it's even more expensive. So the ability to take action prior to that,
Do a little planning.
Tax
on,
planning.
on Roth conversions. You know, if you can just I'll take the little bit of pain now compared to just getting, smoked on taxes. But then on top of that, you're going to have the IRMA part of that a lot of people don't really think about.
But Roth conversions are not for everyone. You have
They're
to
not.
do the tax analysis on it.
Right.
So people think straight across the board a Roth conversion makes sense. Absolutely not, because now
Depends.
you have to calculate, when am I going to break even? When am I going to start making money again? And how much am I going to make?
Right. But even if you, as the investor, are not benefiting from the Roth conversion, maybe your beneficiaries are, and maybe that's the
If
10th
that's
of the
important
count.
to you.
So every situation is a little bit different. But what I would say about RMDs in closing is if you're 72 or above, you might have to take an RMD, depending on your birth year. And they're going to be taxed as ordinary income. You don't want to leave it in the account, otherwise there's a 25% penalty starting January 1st of 2026. That's right. Plus ordinary income. But there are ways to prevent this, like Roth conversions, donations. I think a lot of people are making more donations than what they really think. And if you don't need the money, that may be a very smart tax strategy.
it's
for
to
you.
Especially
minimize
if you're using that after tax money to make the donation, you are losing money on that donation.
Right.
Because you can do it.
Right.
With
Especially
your
qualified account.
Especially if you are on, standard deduction. And for a lot of older clientele, once they're above 72, more than likely probably don't have a mortgage. They don't have a lot of itemizations that they can benefit them for that. So, the qualified charitable distribution, QCD, is one of the few ways that you can really do that and try and minimize the taxes for it.
So great topic about RMDs. That's such a good topic. We could go on and on about RMDs and ways to avoid some of the RMDs and the taxes. But with that in mind, let's get to question number 5, just for the sake of time. How are my investment accounts protected against fraud?
Great question. So for both custodians that we use, they actually employ a $150 million insurance policy through Lloyd's of London in case you do get either hacked or fraud.
So who's a custodian?
So a custodian, good question. Charles Schwab, Axos Bank, Fidelity, they're the ones who actually hold the assets. Like for us at Trajan Wealth, they get invested. It's not us holding it. Bernie Madoff, when he executed his fraud, he actually had checks made payable to him. So whenever we do have clients starting their accounts off with a check, the check's not made payable to Trajan Wealth. It's made either to Axos Bank or to Charles Schwab. So both of those custodians employ, like I said, the insurance for that. But on top of that, a lot of times if someone impersonates you for a wire, different things like that, they will also make you whole for that because that's not you. So a lot of times when people talk about, well, hey, what about if the custodian goes belly up? Okay, if the custodian goes belly up, there's really no impact on you because the holdings in that didn't go belly up. So if you've got Johnson & Johnson, NVIDIA, different companies, they didn't go belly up. The company that holds that does, and it just gets taken over by another custodian. So it just goes to a different company where your money is held.
So that's SIPC insurance is for brokerage failure. So if your brokerage fails, it's insured up to $500,000 or up to $250,000 for securities not yet invested.
So how's that different than FDIC?
FDIC is federal level, so think banks, banks, credit unions, places like that. So this is not related to the banking industry. This is securities, totally different.
Yeah, FDIC is up to $250,000. So
Per
that's
account.
banks, deposits, et cetera.
Per tenant.
Per tenant. SIPC is up to $500,000.
That's correct.
Same rules. So it's Securities Investor Protection
Right. If
Corporation.
the firm goes belly up.
Correct.
But if a company that you invested in goes belly up, then that's a different story. There's no protection on that.
And I'm sorry, credit unions are NCUA. That's why we have the
right.
NCUA, not FDIC.
Yeah, so the biggest advantage to investing with a company like Trajan Wealth is we use a professional custodian.
We are arm's length distance to our clients' money.
Right. You'll never make a check out to Jeff Jr., Marty Bryant, Corbett LeDuc, any of our advisors, any of our team.
I mean, you can if you want to.
As long as it's less than $250.
Right, yeah, that's right.
Right.
We have to
Well, we'll go
report
to
that
jail.
compliance.
Yes.
Yeah.
Darn it, SEC.
But the checks and the investments are held by the custodian. Schwab, Axos, companies like Fidelity's another one, Vanguard, et cetera.
Vanguard.
So these are all custodians who actually hold the money. Now, that doesn't mean that Schwab or Axos is managing the money.
Right.
They're holding the money. You're hiring Trajan Wealth to manage the money.
Right. And it really, so think of it as you're going to build your house at Axos and you're going to invite us into your house to manage the money. And it's completely at will at any point in time. If you don't want to work with us anymore, you can kick us out of the house. But it works both ways. So if clients are jerks and they're not nice to us, we will kick them. We will kick ourselves out of the house. And they can go somewhere else. So again, it's just you're inviting us in to manage your money, completely at will.
So great question. Great question. And I'd imagine a lot of people are wondering it, just too afraid to ask because,
Or sometimes they don't think to ask.
or they don't even think to ask.
Yeah.
Right.
You know, because I know very much in the Latino community, you know, they're very fearful of banks and things like that. So actually having physical cash and things like that, you know, the ability for us to educate people and say, yeah, this is different than what banks may be outside of the U.S., a lot better regulation on that, you know, so the ability to have that faith and trust, you know, is for us saying, yes, it's us managing it. To Marty's point, yep, the house is the custodian that actually holds those positions within it.
Yep.
Great. So thanks again for that question. But really, at the end of the day, money is just a tool. The real goal is a life that feels aligned with your values and the people you care about. So thanks again for spending part of your day with us on 5Q IQ Financial Power-Ups with Trajan Wealth. If you know someone who's wrestling with similar questions, share this episode with them. And if you have a question of your own, visit TrajanWealth.com/5QIQ and send it our way. We'd be happy to help. And remember, we're here to help you plan smarter and dream bigger, one question at a time. We'll see you all next week.